Are you a real estate investor tired of getting denied by conventional bank limits, but not desperate enough to pay the massive fees of a hard money loan? There is a secret middle ground that is helping investors scale massive rental portfolios, and it's called a DSCR loan. If you are like many real estate investors, your first experience with mortgage loans likely was with a conventional loan. Conventional loans are the industry name for loans that follow the qualification standards of the quasi-government agencies Fannie Mae and Freddie Mac, also called QM or qualified mortgages. These loans are intended to be sold to these agencies and securitized with an implicit government guarantee for mortgage bond investors and must follow the strict one-size-fits-all qualifying standards of Fannie and Freddie. Many people use these conventional loans for their homesteads or owner-occupied properties. However, conventional loans can also be used for second homes or vacation properties and even investment properties like rentals. Because of the government's implicit guarantee of these loans, conventional loans are often the first choice for homeowners and real estate investors alike, since the guarantee is in the form of a government subsidy, and these loans typically come with lower rates as a result. However, as we will explore in this video, for many reasons and in many situations, DSCR loans can be better options for real estate investors than conventional loan alternatives. This is true despite the fact that DSCR loans are offered by private lenders and when sold and securitized, do not have subsidy or backing from the federal government. In fact, DSCR loans quite often make the most sense for investors, especially as they begin to scale rental portfolios. Time for an FAQ break. Why are DSCR loan interest rates higher than conventional rates? DSCR loans tend to have higher rates than conventional loans because they do not have the implicit government guarantee by Fannie Mae or Freddie Mac. That said, the difference is usually modest, often no more than 1%, and rates can sometimes be equivalent or even lower and come with terms that generally have significantly more flexibility and options. What are the pros and cons of DSCR loans? How DSCR loans compare to conventional mortgage is a deeper question than just comparing interest rates. Yes, rates tend to be higher, but there are many pros to DSCR loans that can be used by savvy real estate investors to scale rental portfolios. Let's break down the advantages and disadvantages and dispel a few DSCR loan myths while we're at it. Benefits of DSCR loans. For real estate investors scaling portfolios or operating outside traditional borrower profiles, DSCR loans offer a unique set of advantages. Unlike conventional mortgages constrained by government guidelines, DSCR loans are designed specifically to align with how investors think. Property first, cash flow driven, and built for scale. 5 core benefits that make DSCR loans a powerful financing tool for sophisticated investors. Benefit number 1, no income verification, tax returns, or DTI requirements. One of the most powerful advantages of DSCR loans is that they do not require borrowers to verify personal income or calculate a debt-to-income DTI ratio. Investors are not required to submit W-2s, tax returns, pay stubs, or profit and loss statements. Instead, the focus is on a debt-to-service coverage ratio, DSCR, which evaluates how cash flow generated by the subject property covers the monthly principal, interest, tax, and insurance payment, aka PITIA. This is a major benefit for self-employed borrowers, real estate professionals with significant write-offs, or investors who have already accumulated several properties and have complicated on-paper financial profiles, potentially with complex tax strategies and business interests that can complicate conventional financing. With DSCR loans, borrowers won't be disqualified because of the way personal income looks on paper or because of a breach of an arbitrary portfolio or DTI ceiling. This structure reflects how real estate investing actually works. Strong deals pay for themselves. Investors can qualify based primarily on property performance, not their job title or income type. DSCR loans unlock the wealth-building power of real estate for qualified borrowers who may not fit inside the traditional lending box or are ready to make the leap into full-time real estate investing. Here's another commonly asked question on this topic. Do DSCR loans require income verification or tax returns? No. One of the most popular aspects of DSCR loans is that there is no requirement to provide pay stubs, employment information, or tax returns, allowing both easier qualification and less hassle. There is no DTI, debt-to-income ratio required in qualifying. Instead, rental income from the property is utilized, and lenders don't look at personal income or employment. Benefit number 2. LLC and entity-friendly lending structure. DSCR loans are built for professional investors, and that includes supporting entity-based property ownership. Most DSCR lenders not only allow, but often encourage borrowers to take title in an entity, like an LLC, corporation, partnership, or trust. This approach provides significant advantages for real estate investors, such as asset protection, tax structuring, and operational flexibility. Holding properties in an entity helps separate liability from personal finances and credit and simplifies building partnership structures. This is especially useful for investors whose strategies include collaboration with others who have complementary skill sets. One person may bring capital, another may manage operations, and another may focus on acquisitions or design. DSCR loans make it easier to structure these partnerships cleanly under one entity with clear ownership roles and protections in place. This flexibility also allows for more sophisticated arrangements, such as small syndications or using multiple LLCs to manage different parts of a portfolio. While DSCR lenders typically require a personal guarantee from the borrowers, many will allow minority owners, typically those owning less than 25% of the borrowing entity, to not have to provide a guarantee. In addition, some lenders will qualify the loan using the higher of two borrower credit scores in a partnership, giving more flexibility when structuring who signs and how credit is evaluated. Finally, DSCR loans held in LLCs often do not appear on the borrower's personal credit report, reducing credit utilization concerns and further insulating the investor's personal financial profile. For serious investors treating their real estate business like a true enterprise, DSCR loans level the lending playing field with access to entity-friendly benefits, usually reserved for only institutional-level players. Time for an FAQ break. Can I get a DSCR loan under an LLC or business name? Yes. In fact, most DSCR lenders prefer that you borrow under an LLC or entity, and in some states, this arrangement is actually required. Additionally, DSCR loans are typically available to be in the name of trust or corporate fund structures. Benefit number 3, higher loan amount limits. DSCR loans routinely allow for higher loan amounts than traditional agency or bank loans. While conventional loan bank limits cap out at $832,750 for a single-family property in 2026, with some exceptions in high-cost markets and for 2 to 4 unit properties, DSCR loans often extend well into the 7 figures. Many lenders offer DSCR loan sizes of up to $3.5 million per property, and specialized programs can go even higher for select investors or portfolio loans. Investors who focus on high-performing short-term rentals, STRs, in luxury markets or high-demand destinations like Orange County, California, or Manhattan, where an average single-family home prices regularly exceed $1.5 million, often find the conventional loan limits fall short. DSCR loans provide a financing option for real estate investors focusing on high-end rentals, which can be some of the most lucrative properties available, and a necessity in some markets where saturation has been a requirement, not a luxury, to stand out in size and quality. Benefit number 4, no cap on number of properties financed. Conventional financing places a hard cap on portfolio growth, as agency guidelines strictly limit borrowers to a maximum of 10 financed properties per individual, including primary and second homes. Once that threshold is reached, conventional loans are no longer available, regardless of credit score, reserves, or property performance. For serious investors looking to scale, this ceiling becomes a major roadblock to finding true financial freedom through real estate. DSCR loans have no such restriction or hard cap on number of properties. Because each loan is evaluated primarily on the income of the property itself, lenders are typically unconcerned with how many other properties the borrower owns, and neither income or expenses from other personal professions nor profits and losses from other properties are typically considered in DSCR loan qualification. This flexibility is essential for investors pursuing financial independence, whether through long-term rentals, STRs, or a diversified portfolio strategy. For many, building a portfolio of 10 or more properties is the point at which real estate becomes a full-time income source, and DSCR loans are often the only practical path to get there. Here's another commonly asked question on this topic. Is there a limit to how many DSCR loans I can have? No. DSCR loans generally contain no cap on the number of properties or loans you can have, making them ideal for investors building portfolios with 10 or more rental properties. Some DSCR lenders may have caps for individual borrowers, but they are usually never hit, i.e. at 25 properties or $10 million or greater in real estate, and crucially apply to each lender individually, so borrowers can typically reset any caps with a new DSCR lender. Finally, benefit number 5. One of the strongest advantages of DSCR loans is their flexible and adaptable underwriting. Because these loans are not bound by Fannie Mae, Freddie Mac, or FHA rules, DSCR lenders create their own qualification standards and guidelines, allowing them to move faster, evaluate a broader range of property types, and accommodate evolving strategies like midterm rentals or BRRRR more effectively than conventional lenders. DSCR loans have become the top and sometimes only option for several areas of real estate investing. Some of these areas include the BRRRR strategy, where investors need to be able to execute cash-out refinances in short timeframes, much more quickly than conventional options allow. Finally, DSCR lenders have much more leeway in being able to evaluate deals on a case-by-case basis and grant exceptions. This is not an option for conventional lenders who must comply with strict rules and regulations. The flexibility empowers investors to pursue creative deal structures, act quickly on time-sensitive opportunities, and finance properties that don't fit neatly into conventional underwriting checklists. Just as important, DSCR loans typically require far less burdensome documentation requirements. While not no doc, they eliminate many of the most frustrating elements of traditional mortgage applications, such as explaining every bank deposit, submitting full tax returns, or justifying personal income from multiple sources. In short, DSCR loans are built to support how investors actually operate in the real world. Investors using DSCR loans are not forced into the slow-moving system of conventional financing built for average families and homeowners. By the way, if you already have a property locked up and you're ready to get funded today, check out the link in our description to access our quick web application. Time for an FAQ break. Who is a typical DSCR loan borrower? DSCR loan borrowers can include everyone from first-time investors to moguls with over 100 properties. However, the sweet spot for DSCR loan borrowers are those with 5 to 50 properties, ready to scale after their first few, but not quite institutional in nature. Collectively, these benefits explain why DSCR loans have exploded in popularity and have become the go-to option for real estate investors scaling portfolios. Many real estate investors make the leap from conventional loans or local banks when they hit around 5 properties. Whether it's hitting up against DTI limits, scaling past loan limits, entering the high-end markets, or simply becoming tired of hassles, the road to financial freedom through rental properties often arrives at DSCR loans once the properties start adding up. Drawbacks and downsides of DSCR loans. It's not all sunshine and rainbows. The flexibility of DSCR loans comes at a cost, usually in the literal sense of higher interest rates and fees, and they aren't the right tool for every scenario. Here are some key disadvantages to weigh when considering if a DSCR loan is the right choice for financing a rental property. DSCR drawback 1. Typically higher interest rates and fees. DSCR loans typically come with interest rates that are 0.75 to 1% higher than comparable conventional mortgages. However, the impact may be less than many expect. On an average size loan, for example, with a balance of $400K, the monthly payment at 7% DSCR versus 6% conventional is only about $263 higher per month on a 30-year fixed mortgage, a manageable difference for many investors, especially when accounting for the increased flexibility and ability to close under an LLC. DSCR drawback 2. Not for personal use or second homes. Conventional loans allow for a hybrid property approach, meaning borrowers can finance a vacation home they use for part of the year and rent out for the rest. DSCR loans aren't eligible for second home use. Many real estate investors like to mix their real estate business with pleasure, enjoying a vacation property both for personal use and to provide rental income. However, for vacation properties financed with DSCR loans, personal use must be limited to no more than 14 days per year. Anything more, and the property would no longer qualify under DSCR loan business purpose requirements. These restrictions make DSCR loans a poor fit for hybrid use strategies as they are designed for pure investment properties with specific income-producing intent. DSCR drawback 3. Prepayment penalties. Another commonly cited downside to DSCR loans is the prepayment penalty, a provision in some DSCR loans that requires the borrower to pay a fee if the loan is paid off early, whether through a sale or refinance during the first few years of the term. Prepayment penalties come in various forms with different fee amounts and durations, i.e., how many years into the loan term they apply. While DSCR loans don't typically require a prepayment penalty, borrowers will generally need to accept one, often covering the first 5 years of the term and sometimes amounting to up to 5% of the loan balance in order to access interest rates comparable to conventional loans. In general, the higher and longer the prepayment penalty, the lower the interest rate. Borrowers willing to accept the most aggressive prepay structure, typically 5% for the first 5 years, may be able to secure a rate even lower than a conventional alternative. Many real estate investors follow a long-term buy and hold strategy and have no intention of selling within 5 years, making the lower rate a net benefit. DSCR lenders also often offer flexibility with different prepayment penalty structures, giving savvy borrowers the ability to align financing with a strategy, a level of customization, and optionality rarely seen in conventional lending. And finally, DSCR drawback 4, not suited for properties that need work, fixer-uppers. DSCR loans are designed for rent-ready, turnkey properties only. If the property needs significant repairs, even for instance, if just one unit in a multi-unit property is unlivable, the property is not eligible. Appraisals must reflect the property is habitable as is with no major repairs required, less than only $2,000 of deferred maintenance. This means real estate investors pursuing the often lucrative value-add investing strategy, such as fixing and flipping or fixing and holding, i.e. the BRRRR method, must use a two-step process if they need financing. This usually entails starting with a hard money loan to fund the purchase and the rehab, and then refinancing later into a DSCR loan. While DSCR loans aren't a fit for investing in fixer-uppers, the good news is that there are plenty of alternatives to finance properties in need of renovations, and DSCR loans can still be used to refinance a post-rehab rent-ready property. Time for an FAQ break. Can I use a DSCR loan to finance new construction or a property under renovation? No, DSCR loans cannot be used for construction and must be turnkey at closing. Let's pull this all together with our summary chart. How do DSCR loans compare to conventional mortgages? Qualification. DSCR loans use property cash flow, the DSCR ratio, while conventional loans use personal income and the DTI, debt-to-income ratio. Documentation. DSCR loans require no W-2s and no tax returns, while conventional loans require full income docs, like W-2s and tax returns. Loan limits. DSCR loans have an uncapped number of properties and go up to $5 million, while conventional loans max out at 10 properties with an $832,750 limit as of 2026. Interest rates. DSCR loans are approximately 0.75 to 1% higher, while conventional loans are lower due to being government subsidized. Entity ownership. DSCR loans allow for it, such as with an LLC, corporation, or trust, while conventional loans require ownership to your personal name only. Prepayment penalties. On DSCR loans, it is common, usually 1 to 5% for the first 1 to 5 years. On conventional loans, there are none. And finally, who are they best for? DSCR loans are best for scaling investors, SDRs, and BRRRR, while conventional loans are best for first-time investors and house hackers. Here's one last commonly asked question. Are DSCR loans easier to qualify for than conventional mortgages? Typically, yes. It's easier to qualify for a DSCR loan than a conventional loan in many cases, primarily because to qualify for a DSCR loan, there is no need to achieve certain debt-to-income DTI hurdles and no need to provide tax returns or verify income. And there you have it, the complete breakdown of DSCR loans versus conventional mortgages. While they are an amazing tool, every real estate journey has its own hurdles. If you want to learn how to navigate them like a pro, head over to harpooncapital.com and fill out our Contact Us form. When you do, we'll send you our completely free ebook, 10 Obstacles for DSCR Loans and How to Overcome Them. Don't forget to like this video, subscribe to the channel, and check the description for all the links we mentioned today. Happy investing, and we'll see you in the next video.